The face cannot
Good afternoon, everybody. So in our last class, let me know if you can hear me, please. I don't know if anyone of you can hear me. Can you hear me, please?
So can you hear me? Yes, we can hear you.
Okay, thank you. So in our last class, we were looking at hydrocarbon, and today, by the grace of God, we are going to conclude on this topic. Okay, so as I was saying, we have looked at capital allowance. We've discussed capital allowance extensively. I think we have also discussed production allowance, have we? Okay, so the purpose of production allowance is for the government to encourage production of crude oil so that the government can earn more, and any investments in this upstream that will bring more production, government is trying to encourage it more. And that is why this act was introduced, this part of the act was introduced. So for a company that is operating on onshore area, the production allowance that the company would get is 50 million, maybe $8 per barrel, and 20% of fiscal price, up to a cumulative maximum production of 50 million barrels from commencement of production, and lower of $4 per barrel and 20% of fiscal price. This is what we are saying. So if a company is operating on onshore, and the company produce crude oil up to 50 million barrels, the production allowance that the company will get will be the lower of $8 per barrel and 20% of fiscal price. So imagine the fiscal price is 75 or 80, let's say 80. Okay, by the time we calculate 20% of $80 per barrel, that will give us 16. And the act already said lower of $8 and 20% of the fiscal price. Therefore, in that regard, we are going to take $8 and multiply by any production that the company has in that particular fiscal year. Now, if by virtue of the fact that the company has now produced more than 50 million barrels, such a company will be allowed to take a production allowance of $4 per barrel, lower of $4 per barrel, and 20% of fiscal price. Let's still assume that the fiscal price is still $80. So 20% of that is 16. You compare with 4, you notice that they will take that of 4. So this is what I am saying. For example, if a company produces let's say 30 million barrels. No, let's say 30 million barrels, right? We are saying that the production allowance for this kind of company will be lower of 20% of fiscal price. And I'm saying let us assume that the fiscal price is $80. Let's assume the fiscal price is $80. So if I say 20% of fiscal of that $80, that will be $16. I will now compare that with the price that the act says, which is $8. The taxpayer will be granted a production allowance of lower of these two. So the lower of these two is 8, and that 8 will be used to multiply my 30 million barrels. 8 times 30, that will be 240, abi? Yeah, thereabout, $240 million. That is the allowance this guy will get. Now, peradventure, the guy has now produced more than 50 million. Let's say the guy produced 60 million. And let's assume the guy has not produced anything before than producing the 60 million. So we say first 50 million is going to get allowance of lower of $8 and the fiscal price. That is, let's still use the same analogy, 8. The remaining 10 million will fall into the next threshold. And the next threshold is over 50 million. That is lower of $4 and 20% of fiscal price, which is still going to be the $4. So at the end of the day, this guy will be granted 8 times 5, that is 400 million. 4 times 10, that is 40 million. So the total this guy will get is 440 million as production allowance. But what the examiner has been doing these days is that examiner does not really bother you guys with this calculation, because examiner usually provides the production allowance. But it's just be good for you to know that there is calculation to production allowance. If the company is operating on shallow water, their own threshold is 100 million. Anything above 100 million will be the lower of $4 per barrels and $20 of the fiscal price thereafter. So the same thing that we did here is what we are also doing here. For offshore, the barrels is 500 million barrels threshold, and the production allowance will also be $8 per barrel, lower of $8 per barrel, and 20% of the fiscal price, up to cumulative maximum production of 500 million from commencement of production. And if it is now more than 500 million, it will now be based on lower of $4 and 20% of fiscal price. So that is what they are doing. So if you look at this illustration, Killer Oil Upstream Petroleum Company Limited was established several years ago, and the following data for crude oil production for the year ended 31st December 2023 is provided in the schedule below. Area of operation: onshore, shallow waters, and deep water. Prior production that this company has, they have 53 million, 90 million, 900 million. And current production they have is 7.5 million, 35.75, 47.2 million barrels. And when you look at this, you will notice that the cumulative production they have for the onshore is $60 per 60 million barrels. The other one is 125 million barrels, and the last one is 947 million barrels. Now, assuming the price of the crude is $125 per barrel. So we're now saying the company disposed all the crude in the current year at the at the fiscal oil price as advised by the Commission. You are required to compute the fiscal value of the crude oil sold and also compute the production allowance for the year end. Now, for the current year, the fiscal price of this crude oil is actually 125, right? So, and that is what we use to compute our revenue or fiscal value of oil. So I'll just multiply it and get my value. But that is not where we are going. We are going to production allowance. Now we are saying, just like I've explained the other time, in this regard, the assumption here is that this company has never claimed production allowance. So I remember the law says that we take 450 million for the onshore company. We are going to multiply it and also check 20% of the fiscal price and check the lower of the two. And when you look at this, if we take 20% of this guy, it's going to be more than this. So we take the lower of the two as production allowance, which is 40 million. By the time you multiply all this, you get 40 million. Now, if you remember, you will notice that this company's total production is 60 million, right? So the balance, which is 10 million, will also check lower of $4 per barrel and 20% of the fiscal price. And 20% of the fiscal price is also more than the barrel. So we take the lower. So we add the two together to get the total allowance to be claimed by this company. The same thing goes for shallow water. The threshold is
Excuse me, I have a question. In the form, the brought forward, if we go up a little bit, please. He said the prior year production. Wouldn't they have claimed this production allowance the previous year before this current year production?
That's why I said my assumption here is that this company has never claimed. Do you understand me?
Yeah.
But let us assume this company had claimed before. So this 7.5 million is only the one that I'm going to calculate for. And because the company has now passed the threshold of 50 million, we'll go to the second one. So that means we'll just say 7.5 million multiplied by at $4 and 7.5 million at 25, $125 multiplied by 20%, they said lower of these two. So that means at that instance, if the company had not claimed before, so if the company had claimed before and we're only calculating for the current year, we would have used the 7.5 million. They've now passed the first threshold. That means they are only going to be affected by the second condition. If you have passed 50 million, so we're going to do $4, lower of $4 and 20% of the fiscal price. That is what we are going to use. Any question? Okay. In the absence of no question, we'll move on to the next one. So the same thing is applicable to every other one. So go through it. And if you have any question, let me know. Now, but just like I've told you, examiner will not likely to bore you with these aspects because it would have given you the production allowance. If you look at the last 4 past questions on Petroleum Industry Act, they've never asked students to calculate production allowance. But in case they ask you to calculate it, you now understand how to get the production allowance. If you are with me, I'm with you. So the next one that is very important in our computation of hydrocarbon tax is the cost price ratio. Now, the essence of this cost price ratio is to ensure that the total expenses that the taxpayer will claim in a particular year shall not be more than 65% of the revenue of the company. So this is restricting the expenses to be claimed by the company to 65% of the revenue in a particular year. And in calculating that, especially the CPR, the Act says that we are going to be comparing this one with everything that we have here, and you take lower of the two. Now, you have to get all the operating expenses allowable this time. You had capital allowance plus it. Then, the operating expenses stated above exclude the following. That is, you will deduct the following. Rent in pursuant to petroleum mining license and petroleum processing lease, in pursuant to royalty, contribution to any fund or scheme or arrangement approved by the government. Example of that will be Host Community Development Trust Fund, Environmental Remediation Fund, Nigeria Delta Development Commission, and other similar charges. Note, however, that production allowance is not part of this calculation. Production allowance is not part of this calculation. Now, note, as I was saying, let me quickly give you the format. I want to show you the format that you will need in calculating your cost profits. So, this is what I am explaining. Your gross revenue, maximum of what? Allowables of 65% of the gross revenue will be this. Now, the next one is computation of OPEX. Just like I've explained, it is your total OPEX, add capital allowance, and less all other contribution, all this. I've said it the other time. So you deduct it from it to get your adjusted OPEX for consideration of CPR limit. Now, once you get this guy, you will now compare this guy with this guy. The lower of the two, the lower of this and this, is what the taxpayer will be allowed to take against the revenue in that particular year. Do you understand me? So that is that. Now, I haven't said that. If, for example, the company is unable to relieve its allowable profit due to the fact that we have restricted the CPR, we have restricted the expenses through the CPR means, then the balance that is unable to recoup can be carried forward to the subsequent year so that you can take advantage of it again in the subsequent year. Do you understand? So that is that. Any question? Any question?
They can be carrying forward almost perpetually if they cannot recoup it the next year.
Yes.
Anything left, they carry to the next year, the next year, the next year.
They will continue to carry forward until they are able to recoup it. There is no restriction to the number of years in which a company can carry forward this unrelieved balances. So let's move on. Also, we're going to also talk about royalty. Royalty is in two forms now. You pay royalty in kind and royalty in cash. Sorry, royalty in kind, that is based on your production, and you also pay royalty based on the price. So I said royalty is based on two things, based on production and based on price. based on production and based on price. Okay. So, and this is what I'm talking about. So royalties are paid based on in two ways. We pay it based on what? Production and based on price. So that is how to pay royalty. Now, in doing that, royalty based on production shall be based on the production per day. What do you produce per day? That is what that is all about. So if a company is an onshore company, okay, and the production per day is greater than 10,000 barrels per day, the company would be subject to a royalty rate of 15%. And that is why we put the 15% by this side, or 15%. If the company is a shallow water company, the company will be paying a royalty of 12.5%, provided the daily production is greater than 10,000. Companies within the 100 and 200 of water depths would also be paying 12.5% of royalty, provided they have a production that is greater than 10,000. Royalty is like a fee you pay to extract things from the ground, okay? And for governments, they believe so much is that those things that you're extracting belongs to me, even though I'm not able to extract it. So you will pay me royalty for extracting my resources, okay? Now, again, if the production is, if the company is a company that operates on a continental shelf beyond 200 meters of water depth, and the production is between 1 to 50,000 per day, the company will have to pay 5% of its production of its production. You have to pay 5% of that to government. So if you are producing 1 to 50,000 per day, 5% as fiscal price will be paid to the government. So if I say 5 multiplied by this, 5% multiplied by this, if the fiscal price is $80 per barrel, then we multiply by $80 per barrel. So that is that. Again, I don't want to bother myself too much on this because examiner will give you. But where examiner could ask question on this year is this part. You have these notes. What are the penalties for non-payment of royalty? The penalty shall be equal to 10% of the amount due that you did not pay. 10%. And the due date for payments is within 2 months. You must pay within 2 months. And at the same time, if the transaction is in foreign currency, you are going to pay LIBOR rates on the outstanding. You pay LIBOR on the outstanding. That is the current percentage of 10% plus LIBOR. Now, again, apart from this, you have to pay 10 million or US dollar equivalent on the first day the failure to pay the royalty occur, and 2 million or US dollars equivalent on the subsequent day in which the failure continues. So that is what the act says. I'm not going to bore you much about that, but let's go straight to administration of tax filing by this kind of company. Basically, company that operates in this segment prepares their accounts in two forms. They have two types of returns. The first return they have is the estimated returns, while the other one is the annual returns. According to the Act, estimated returns must be filed within 2 months in the accounting year. That is on or before February 28th or 29th, as the case may be, for filing of returns. Meanwhile, for annual returns must be filed within 5 months after the accounting year end. What I am saying here is that annual returns must be filed within 31st or not before 31st May of the subsequent months. So that is what we mean by annual returns and the estimated return. I'll also give a clear indication of this. Annual returns is for prior year, while estimated returns is for current year. Estimated returns is for current year. And according to the Act, the taxpayer is expected to pay tax on the estimates that they will file with the government on a monthly basis. And such estimates will be due for payment a month after you have filed your estimated returns. That is, on or before 31st March of that year. So what we are trying to say here is that you give us your budget, you compute your tax yourself, and tell us what you are likely to be paying at the end of the year, and remit same on a monthly basis. That is what the answer is. Now, assuming the company had estimated that they are going to pay $80 million. So the first installment, they've made payments. Second payment has been made. Third payment has been made. So they have now made 3 payments. Let's assume that the total amount that they have estimated is 120 million, so that it will be easier for us. The first thing you do to get the first installment to pay is to divide the 120 million by 12. So that means in each of the months, that is from March, the company is able to pay 10 million as an installment. Pay 10 million as an installment in the first one. Second one, pay the next installment, which is 10 million. Third one, 10 million. But note, however, that there could be revision to these estimates. The taxpayer could revise these estimates. Now, when the taxpayer revises these estimates, that means the taxpayer would have to recompute the estimates that would be paid going forward to the tax authority. And that is why I put this formula. That means the estimated tax, the new one that you know, less the tax already paid divided by the number of months remaining. If a taxpayer fails to pay the tax, the installments, the taxpayer is liable to a penalty of 10% plus interest rates. So the taxpayer will be liable to a penalty of 10% plus any prevailing interest rates at the points where the taxpayer fails to pay. And this is a table. After the taxpayer has submitted the estimates in February, the first payment is due in March 31st. Second one, April 3rd, May, and so on and so forth. Now, the 11th one will be due by the next year, January 31st of the next accounting year. The other one will be due 28 or 29 February of the next accounting year. So that is that. Now, what are the content of returns? The content of annual returns is audited financial statements, computation of actual adjustments, adjusted profits or loss, and the actual civil profits. The next one is the schedule showing the total production allowance from all this upstream operation. Also, schedules showing the capital allowance, amount of adjustments, all those things have to be shown. Amount paid have to be shown. The next one is computation of actual chargeable profits for the classes of asset the company has. So you must show us your actual now. It is not estimated, actual. And at the end of the day, you must also show us the evidence of tax payments and fill a self-assessment form that will be used for the purpose of the computation. So estimated returns too, you must file the estimated returns, and these are the contents. If you fail to file your returns, you pay 10 million. On the first day the failure occurs, and 2 million subsequently. Okay, so let's look at this illustration. I think we're going to stop at this illustration. I'm having a headache. Okay, I'm so sorry. We would have to reschedule this class after this illustration. So, Mira Petroleum Development Company Limited submitted its first estimated returns to Federal Inland Revenue Service for 2023 on 27th of February. Just like I've told you, they must submit their estimates within 2 months, right? So, submitting the estimates now means you have computed your estimated tax liability and you are submitting that. So, they will submit that. So when they submitted that, they said, we are going to be paying tax of $60 million. No problem. But in July 2023, this guy submitted another estimate of 84 million. And in November again, submitted another estimate of 90 million. So you are required to indicate the due date for payments. What is the due date? The due date for payments is what? 1 month after, Abby, which is March 23, right? Just like I told you the other time, I said if a taxpayer send in an estimate, the estimated returns must be divided by 12. So we have divided this by 12. We got this. So we got this. We got this. We got this. But in July, these guys submitted another estimate. So what we will do at that instance is to say the new estimate, 84 million. How much have we paid to date before the new estimate? We have paid 20 million minus 20 million. How many months have we done before? We have done 4 months out of 12 months. So it will remain 8 months. I'll just say 84 million minus 20 million divided by 8. We'll continue to have 8, 8, 8, and 8. In November, another estimate was submitted. They said this guy submitted 90 million. That means the new estimate minus the tax already paid, we have paid to these dates. We will add all this together and subtract it from 90 million. That is what I've calculated here. How many months is left? We now have 4 months left because we have done how many months? 1, 2, 3, 4, 5, 6, 7, 8. So we just say 12 minus 8 will be 4 months. So we divide it by 4. We have 9.5 million monthly. So this guy will continue to pay 9.5 monthly. At the end of the day, the total estimate this guy has paid is 90 million. Now, the company is expected to file an annual return. This annual return is filed so that the companies, the tax authority will now know the actual tax liability that this guy is supposed to have paid. that the taxpayer has paid tax on this estimate, which is 90 million. Now, the final tax liability will be seen from the audited statements, and the component of the tax liability will be based on the audited financial statements. Now, having done that in this scenario, this guy is supposed to pay 113 million, but he has paid 90 million. The tax authority is now asking you, determine the 13th installment payable. To determine the 13th installment payable, it is just for you to take the final tax returns minus what this guy has paid. So the final tax return is this. What he has paid 90. The difference between the two is the final tax liability or 13th installments. Do you have any question? Do you have any question? Do you have any question? Hello? Hello?
No, sir.
Okay. So let's reschedule this class. I'm so sorry. I'm just feeling so weak now. Let's reschedule this class to maybe Saturday morning that we usually do. Hopefully, I would have.
There is Mr. Tunde's class on Monday. I think he has a class tomorrow evening. I think that time is free. It depends on which
Okay.
you are looking at.
Okay, I can use tomorrow. The class is free tomorrow, right?
I think so. I think so.
What,
Maybe
what
after
time?
you have
What,
asked him.
what time tomorrow, please?
What time do you guys usually have your class? What time do you guys usually have your class?
8:30 p.m.
8:30.
Can we do earlier than 8:30?
I don't think it's possible because I'm supposed to be on transit by then, but 8 at least we'll try and get home. That's how it is. I don't know.
Okay, let's see the 8:30. What do you think? Or we should just do our Saturday?
See, whichever 8:30 is okay, or Saturday, whichever.
Let's do the Saturday morning, please.
Okay.
Sir.
All right. Sorry, guys. I'm so sorry. You need to see my face now so that you know that I'm not lying. I'm seriously tired. Can you see my face? Can you see that I'm very, very tired? So we need to let's schedule the class, okay? All right, guys. See you on Saturday.